And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. That's right, it's Thursday as we get ready to close out this holiday shortened trading week. So again, Monday a holiday, so really everything kind of crammed into 4 days here. More economic data coming out today as well as earnings still kind of, got a few little stragglers coming in today. In terms of earnings. So again, we are wrapping earnings season up for the most part, but don't worry because the end of the quarter is up on us and we'll be starting earnings season all over again before you know it. That's just the way the markets work. So as soon as you get it over with, we're back at it. Couple of things we'll get into today, talking about interest rates and bonds. Michael Leibowitz joining me this morning, also talking about the upcoming Fed meeting. Will they, won't they? That's the big question. Will they hike rates? Will they not hike rates? Or is the Fed done? And when it comes to talking about bonds in particular, what the Fed is doing has a big impact on bonds. And so, this is what this happens at this next meeting, and what kind of, the economic data is telling us is certainly going to, kind of weigh on, kind of the future for what is going to happen economically. But we'll get into all that this morning with Michael Leibowitz. Outside of that, it's been very, pretty much quiet. I heard an interesting rumor, and basically, Brent, who's been involved in the media for, 900 years. It was him and Methuselah doing the first newscast when it occurred. I heard that when the traffic people talk about parking at airports, that means there's absolutely no traffic problems going on, right? There's nothing to report traffic-wise. Is that true?
Theoretically.
Huh?
Theoretically.
Yeah.
So they're just talking about how full the lots are.
Right, because there's no other traffic to talk about, right? There's no other traffic jams or anything.
Oh, it's filler.
It's filler.
Yes.
Right? Yeah. So
yes.
they use, because who cares about parking at the airport, right? Nobody really.
I know, I live for that.
Exactly. Every morning. How full is the parking lot at Bush International? It's 43% full. Oh my gosh. I'm not going to the airport. Who cares? So I just want to get to work on time. But that's really kind of where we are right now. There's not a lot going on in the markets. The markets have had a little bit of a pullback over the last couple of days, but really no big news of any consequence. ISM Services Index a little bit stronger than expected. We talked about that recently, that a lot of this economic data has been so weak for so long that you're going to see a bit of a bounce in some of these economic indicators, and we're seeing that. And of course, that's also supporting the Atlanta Fed GDP now, which is kind of posting up here an over 5% growth, almost 6% growth rate for the economy in the second quarter. But is this an economic recovery? Are we moving back into an economic recovery mode of the economy, or is this just a bounce in the data that still weakens as we get further into next year, as the lag effect of all these rate hikes from the Federal Reserve continue to take root? See, I mean, there's so many things that we can speculate on and kind of prognosticate on, but really there's just not a lot happening right now. So we can talk about parking at the airport. Because that's all there is. No, there's actually a lot of stuff going on. Just not a lot news-wise this week. It's been pretty tiring. Really kind of the big news this week, more than anything else, has just been kind of the rise in oil prices, because as we've been talking, kind of about the economy and inflation and this type of stuff, we've seen kind of a pickup here in oil prices as of late. And of course, this has gotten the media's attention because of this rise just over the last few days. Kind of the big news was the extension of the OPEC and Russia oil production cuts. But again, this rise here really is nothing that's not been part of the rise that actually started back in June. Oil prices bottomed back in June. They've been in a steady climb ever since June, and all of a sudden it just now kind of got media attention this week. But again, this isn't really news. The oil prices itself are still well contained within a long-term kind of range that they've been in. In fact, they're really pretty much in the same level that they were back in July of last year. So we've really gone nowhere in terms of oil prices in the course of a year. So, kind of all this hand-wringing and angst over the recent rise in oil prices really doesn't mean a whole lot. Again, it's not really news, but again, we needed filler for the media. So they can't report on parking at airports, so we reported on oil prices moving up here slightly. So anyway, here's what you need to know before the bell this morning. Market sold off a bit yesterday, and again, we talked about a couple of days ago that the market's has had a very nice rise here as of late. And we came off this kind of the sell-off that we had back in August, had about that 5% decline that we've been talking about, had this rally. Market's got a little bit overbought here short term, and we spoke about that. We're still on a buy signal here. So again, a bit of a pullback here to support, and we're kind of flirting with that right now. Yesterday touched the 20-day moving average, closed right at the 50. This morning, markets are set to open a little bit weaker this morning. We'll see whether or not that weakness kind of stays all day or not. But again, we're still kind of working through this kind of pullback here. We've got support that kind of runs all the way back here to really the middle of June, in particular, where we're going to have this intersection of where the market is trading. So again, a good bit of support where we are right now. But again, this kind of oversold reflexive bounce that we've been talking about, we've had that here again. So there's nothing wrong with the market technically. Markets continue to kind of operate in this rising kind of bullish trend line ever since the lows from a couple of months ago. So again, nothing really to worry about here. The markets are going to give us a pullback. As we talked about before, it's just, that's just kind of part of the ebb and flow of the markets. Again, when you listen to the media, it's like, oh, third negative day, it's terrible, we're back in a bear market. No, it's just a function of the markets, isn't it? And so just don't get overly excited about this. Again, you've been looking for an opportunity to add some exposure to portfolios. Market's giving you an opportunity. Yesterday, Apple down fairly sharply because of news coming out of China that they're going to restrict their government officials from buying and using iPhones. But again, this is just kind of one of those situations where potentially you get a little bit of an opportunity to add to exposure, in a company maybe that you've been looking for. And again, you can kind of see this yesterday. Apple had a fairly sharp correction. Again, because it's one of the largest stocks in the overall index. Not surprising it dragged the index lower, but it also sitting here nicely on support right at the 100-day moving average. So again, on a buy signal, was overbought, need a little bit of a correction here. That happened yesterday. So again, so the point here is simply look at market corrections when you're in a bullish trend as an opportunity to add exposure as needed. If you're in a bearish trend, then you use rallies to reduce exposure. And again, that's just kind of the way the markets work. So nothing really much to worry about here, but that is what you need to know before the bell this morning. So when we come back, from the break, I want to get, particularly into talking about some things that we've done in our own portfolios over the last couple of days, and really something we've been talking about over the last couple of weeks, because this does have a lot to do with what is going on currently with interest rates and what's been happening with interest rates as of late. Again, lots of concern, not a lot of media hype lately over this kind of uptick in rates. Again, rates really pretty much haven't gone anywhere over the last few weeks. But again, this recent uptick got everybody kind of off guard. Again, media needed something here to talk about. But again, this run in rates is starting to get back to overbought levels. We're still pretty much within this range that we've been in for the last several weeks, while markets have been just kind of processing here. But again, when we take a look at where we are currently in terms of rates and look back over a period of time, we're still just within the same trading range that we've been in really ever since the peak in rates back in September. So again, just kind of the cycle of interest rates and inflation and inflationary concerns and positioning in markets. We'll talk about what that means and why we were starting to take some actions in our bond portfolios as well. So when we come back from the break, we'll get into all of that and a whole lot more with Michael Leibowitz. Don't go away.
Different.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Lance Roberts. Michael Leibowitz joining me as well. So lots of stuff to talk about. We've got the Fed meeting coming up next week, I believe. And, this is kind of the moment following the Jackson Hole Summit. And again, we can go back through history and, during these Jackson Hole Summit meetings, the Fed chairman, whether it was Ben Bernanke or Janet Yellen or, again, Jerome Powell, kind of make these statements and kind of these outlooks. And of course, we have to wait until the next meeting for the action to actually kind of manifest itself. And so at the last Jackson Hole Summit, Powell was pretty clear at this point that they're remaining data dependent at this moment, that further rate hikes certainly weren't off the table, but there's also not really any talk right now of cutting rates either. And it's all based on kind of what's happening economically. We wrote a piece on this last Friday, by the way, talking about, Jerome Powell at his Jackson Hole Summit meeting, basically kind of obfuscating the truth on the cause of inflation, which is basically they were the primary culprit of it, along with the government. But that aside, coming up next week, will the Fed hike rates? Won't they? And what does that mean, kind of for the future here and what markets kind of keep hoping for? And we kind of go, as we drift from kind of one meeting to the next, is this the meeting? Is this the meeting that the Fed's going to stop hiking rates? And again, if they don't, then we just kind of drift to the next meeting hoping for the same thing. And this has been a good support for the markets really kind of ever since last October has been this hope of rate cuts. So Mike, what's your thinking at the next meeting here? Will they, won't they? Will they actually make some comments that maybe they're done hiking rates here, given some of the recent economic data? What do you think?
I think it's a lot more of the same. The meeting is actually on the 20th. So next week we'll get CPI and retail sales and PPI. So that'll give the Fed one more look at inflation. And right now those numbers are expected, CPI is expected to rise about 0.2%. Which it's funny, when you listen to the media, go on Twitter, there's a big concern that inflation is rising. And most of those concerns are on the people looking at it year over year. Mm-hmm. So they're looking at the last 12 months, taking an average and seeing what inflation did. But if you look at if it rises 0.2% and you annualize that, that's 2.4% inflation. Right. So when you look at more recent rates of inflation, it's much closer to 2 than the 3 to 3.5% that the market's worried about. So the Fed funds market thinks the Fed is going to do nothing at the September 20th meeting. And then I think the next one is very early November 1st or 2nd.
Right.
Right now, the market is roughly 50-50 that the Fed will hike rates then. But, we're going to have the CPI number next week and then a whole round of new data in October. So I don't think the Fed does anything at this meeting. And to be honest, I think the Fed may be done. Obviously, I don't have, I can't see that data that's coming up. But we are starting to see more and more signs that the economy is slowing. Now, not slowing to a recession, but just normalizing.
Right.
And normalizing sounds good, but normal for this economy, Lance, is 1.5% to 2% growth. And that's where things get a little, I think a lot of people forget that. We've been living in this anomaly now, in this kind of pandemic fiscal stimulus anomaly for the last few years. And when we get back down to 1.5% or 2% growth, it's going to feel like a recession. Mm-hmm. We've been running 3, 4, 5% growth. Inflation's been up to, much higher than that, but kind of settling in at 3, 4%. So the economy is slowing. It's showing signs of slowing. The lag effect is working. And I firmly believe that given what the Fed has done to rates and given what the market has done with long-term rates, with mortgage rates, with auto rates, with corporate refinance rates, we are going to be in a recession. But again, the question is when. And it could be a while. We know that from when the Fed pauses to a recession over the last 4 or 5 of those incidents, going back 40 years, that it can take anywhere from 6 months to almost 2 years. If in fact the Fed did their last rate hike, it was July. Right. So it's not uncommon for, the economy to just slowly cool down before a recession. And then you factor in there's a lot more debt right now than there was during all those instances. And the increase in rates was more significant than all of those incidents. So, I continue to think a recession's coming, but that doesn't mean, it's coming anytime within the next, next 6 months.
Well, yeah, and that's always the case. And then if it doesn't happen, right, and this was, what we saw in 2022. Everybody was like, oh, recession's coming. And then when it didn't come, everybody goes, okay, well, this time is different. It's not going to happen. And so the problem with the markets is always that, and it's kind of like, talking about valuations, right? You say valuations are high, which means stock returns are low. Well, then if you don't have a market crash immediately, everybody goes, well, valuations don't matter. Things just don't work like that. And as we talked about before, we were running nearly 12% growth in 2022. 2021 in terms of GDP because of all that money that we sent in on a nominal basis. And so you've got to reverse all of that stimulus and all that growth. And to go from a very high level of economic growth to 0 to negative, it's going to take time, right? I mean, that's just not going to happen overnight unless you shut down the economy again, which, we're not going to do. So again, to your point, it's just going to take us a while to get towards that recessionary territory. And again, it probably won't be until sometime in mid to late 24, maybe even early 25 before we get there. But it doesn't mean that it's, we've avoided or averted a recession entirely. And again, we've had a big drawdown in some of this economic data, as I said, earlier. And we wrote an article about this a couple of weeks ago that market cycles like everything else. And so when you have an extended period of a slowdown in economic activity, you're going to get a bounce before it slows down again. It's just, you got to go through these restocking cycles within the economy. I mean, I can not purchase certain things for a while, right? And the economy will slow down, but eventually I've got to restock whatever it is, whether I'm a producer or a consumer. There's something I'm going to have to buy to restock just to go for a while. So you're going to get these little ebbs and flows of economic activity, as you're heading towards that recessionary outcome. And again, those little bounces in economic activity delays that eventual onset a little bit further. So, that's just the way the economy works. And again, the way the media works is if it doesn't happen immediately, then, we have to immediately assume that this time is different. It just usually isn't. It just takes us a while for you. It just takes time for the car to get to the destination.
And I think it's important to remember that consumers, corporations, even the government were very smart in the prior few years before rates started going up. Corporations borrowed a lot of money. A lot of homeowners refinanced. So a lot of corporations corporations are a great example. They borrowed a lot of money at 2-3%. Right now their borrowing rates are probably north of 5%. Mm-hmm. So they front ran their borrowing needs with very cheap money. And they're right now, if they didn't use that money, it's sitting in cash earning 5+%. So they're benefiting from higher rates for now. But every day that goes by, there's more of that debt, which was probably 2, 3, 5-year debt, is maturing and gets rolled over. And by rollover, that basically means that 2% bond Apple issued, that was a 3-year bond in 2021, in 2024 has to be reissued, and it's going to be 5 to 6%. When, car loans, every time someone needs to buy a new car, all of a sudden they're paying 7, 8, 9% on a car loan, which, they used to be free, or everyone would have their almost free financing,
right,
to, incentivize car sales. So I think because whether they knew it or not, consumers, corporations, and the government too acted smartly. Mm-hmm. The time it takes for these higher rates to hit the economy is going to be longer. And that's good, but it's also bad because I think it's really hard for the Fed to appreciate or quantify how hard the hit's going to be because you just can't see it. You don't see it in the numbers. So they keep talking about raising rates. They talk about higher for longer. And they're doing damage, but you can't see it yet.
Right.
So I think it's a really tricky situation that the economy's in, that the Fed's in. And, I certainly don't envy Jerome Powell's seat because I think he's dealing with an unknown. And it's almost like a hurricane 100 years ago. Very hard to track and understand what it's going to do.
Yeah, true. And and this kind of goes back to interest rates is a function of what's been going on, and lots of concerns in the bond market over the course of the last few days. In particular, energy prices have been rising after the kind of Russia OPEC production cut extension, and everybody immediately says, okay, energy prices are going up, so that's going to be a big impact to inflation, and that means the Fed's going to have to hike rates more. But again, when you take a look at how CPI is calculated, besides the fact that we measure it on a year-over-year basis, energy makes up a very, very small component of the overall inflation calculation. Housing, by far, and everything related to housing, by far, is a much bigger component and driver of what happens with inflation, including transportation, including food and beverages. But again, importantly, when we talk about CPI, what's the two things we strip out? Food and energy, to get down to core, and core is what the Fed pays attention to. So again, at the end of the day, we'll see how this all impacts interest rates. When we come back, we'll talk about interest rates, and more importantly, we're going to talk about what we did with our bond portfolio yesterday, because we made a very big change to our bond portfolio yesterday based on our outlook for where rates are now and where they're likely going to be, and we'll talk about all of that coming up right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
The bets are on right now for the NVIDIA drinking game.
The Real Investment Show podcast.
Every time NVIDIA says the word AI, you have to take a shot.
Same show, your schedule.
By the time they get through the earnings call, half the country will be completely obliterated and it really won't matter what they say their earnings were, which will be just in time for the debates. Exactly.
At realinvestmentadvice.com.
That's all of the drinking game right there.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So one of the big concerns over the last year or so has been rising interest rates and, of course, bond prices, et cetera, and big concerns about, inflation's going up, so now interest rates are just going to keep going up forever. We're moving back into this new phase of the economy like we saw in the 70s, and there's just massive differences between where we are today and where we are back in the 70s. As Michael Leibowitz addressed earlier, debt as a function of the economy was very low back in the 60s and 70s. Economic growth was running on average at 8%. Savings rates were very high for households. We were 80% manufacturing, 20% services, which had a very high multiplier rate in the economy. Vast differences with what was happening with interest rates in the economy back in the 60s and 70s versus where we are today, where we have massive amounts of debt, deficits, very low production quality, and of course, an economy that's almost 80% services and 20% manufacturing, which leads to lower wage growth and weaker economic statistics over time. And again, this is when we talk about growth rates running between 1.5% and 2% going forward. Even the Fed's own forward prediction for long-term economic growth rates is 1.8% right now. So again, not great. That's not great. But importantly, when we look back, bonds have been under a lot of pressure over the course of the last year and a half. And when we look back in history, and Bank of America did this really great chart just recently, going back to 1787, there has never been a period where you had a negative return on bonds for 3 years in a row. And the reason for that is that interest rates impact economic growth. The higher the interest rates are, then the more drag you're going to have on the overall economy. When the economy slows, And as we've discussed here on the show many, many times, there's a very high correlation, an obvious correlation between interest rates, inflation, and economic growth. You can't have high interest rates and low economic growth. You can't have high interest rates and low inflation. And the reason is that the bond market is pricing for those things. The yield that is reflected on bonds is what is driven by their outlook for economic growth, inflation, opportunity cost, all those type of things. That's what the lender is factoring into the rate that he charges. It's also based on what he can actually loan money at, what people are willing to pay for that debt. So again, this is why we look back over time. Whenever you have high interest rates in a period of the Fed aggressively hiking interest rates, what do you have every time following those episodes? A recession, lower economic growth, lower inflation, lower interest rates. And so this is the reason that Mike and I have been talking about a lot lately, and we wrote about it last weekend's newsletter. We talked about it on our podcast, that we've been analyzing our bond portfolio very deeply and looking to make a bond swap. And so yesterday, we actually did that bond swap. We swapped our holdings in TLT, which is the 20-year iShares Treasury Bond ETF, into an actual 20-year Treasury. And there were some reasons for doing that, and we'll get into all those this morning. But before we get into that, Mike, any comments you want to make?
No, I look at this situation and I kind of salivate. You're picking up such, our yield on that swap trade that you were talking about is over 4.5%. And this is a 20-year bond. So we're not looking at the next 3 months or 6 months. We're looking at 20 years. And when you look at 20 years, you're looking at long-term economic growth rates, at productivity rates, at demographics. They all point downward. The Fed tells us they're downward. They're not. There's nothing to hide. We know, with relative certainty, barring something major that's going to change the way our economy runs, that the growth rate will be over those 20 years probably below 1.5% on average. And to pick up, 3% on that rate is not a once in a lifetime, but those opportunities don't come around.
Right.
And, go back from the financial crisis to the pandemic, you were lucky to get a positive rate, a positive bond yield over the rate of economic growth or inflation. Now you're getting paid 3% and everyone's running scared.
But that's usually the case, right, Mike? I mean, when stocks are going through a major market meltdown, nobody wants to buy stocks because they assume that the stock market's going to zero. We'll go back to 2008 is a good example of that. In 2008, stocks are declining, and everybody's predicting that the stock market's going to zero, and so nobody wanted to buy stocks at the bottom of the market, but that was the opportunity to buy something. And again, here we are once again, the vast majority of the mainstream media coming up with every reason why interest rates can only go higher from here. But there's simply an economic connection to interest rates that suggests that is not going to be the case, and history says that. Now, I want to make one thing very clear, though. Mike just said that we're looking for the next 20 years out, and there's a couple of points that he's making here is very crucially important. The first is that I can't tell you how many people come along every day and say, boy, if I could just get 5% on my money, I'll just lock it up and go home for the day. Well, here you are, 4.5% on your money. That's pretty close to 5. It's within spitting distance. And so here's an opportunity to get 4.5% on your money for the next 20 years with an absolute guarantee of repayment of your money. No principal risk whatsoever. This is termed a risk-free investment because it's a government bond. The second thing is we have no intention of holding it for 20 years. So when we go through the next market decline, when interest rates do fall and interest rates come in line with long-term economic growth projections, then the price of this treasury will have appreciated to the point that we will have maximized the capital appreciation out of this bond, and we'll be able to sell that for a capital gain. And at that point, most likely, this will be the point where nobody wants to buy equities again because we'll have gone through a recession and an equity downturn and markets are down substantially. The mainstream media will be wringing their hands about why the stock market is only going to go lower from here. But when we reach that low point on interest rates and inflation has declined and economic growth is in a recession, that's when we'll want to sell this treasury. We'll maximize the price appreciation, and then we'll want to be buying equities cheap because valuations will now justify owning equities over fixed income. Mike, fair statement?
Absolutely. Yeah, I'd be shocked if we own this thing for more than 3 or 4 years. Likely at some point we are going to have the recession I think we're going to have. Stock prices will go lower. Bond prices will go much higher. Bond yields will go back to where they go during recessions, which, there was a 10-year bond at 0.5% not that long ago.
Yeah.
So, yields fall and we work out of the bonds and back into stocks and take advantage of lower stock prices and, the capital appreciation on the bonds themselves.
So there's also a couple of other reasons why we elected. So we could have done a couple of things, and we had talked about some different ideas on the show, and we'd written about some different ideas in the newsletters and as well as our weekly blogs. And we've been covering this topic a lot over the last really month or so, talking about bonds and interest rates. And I've got another article coming out on it next week as well. But the point is that we did a lot of evaluation. We talked about potentially swapping one ETF for another, and maybe extending out duration and buying a different ETF that had a little bit more duration to it. There were kind of 3 reasons ultimately that we settled on just swapping it for an individual bond. One was obviously that as opposed to an ETF, when you buy an individual bond, if something goes horribly wrong, and let's say that Mike and I are entirely wrong, we're about to enter into the greatest growth dynamic of the economy that we have ever seen. Socialism works. And, we have the capitalist experiment dies and we just blast off into a world of prosperity never before seen on the planet Earth. And interest rates rise because of that economic prosperity. Well, in 20 years, we will get paid back all of our principal, right? No matter what happens to interest rates, there's a guaranteed repayment of principal that you don't have in an ETF. The second reason is that we reduced expenses to the portfolio. The bond carries no expense ratio. So the ETFs, they have an expense ratio, they have an operating cost, et cetera. So we've now eliminated that part out of the bond portfolio as well, reduced expenses to the overall portfolio. And then lastly, of course, we have a guaranteed set of income coming in now. So the income paid by the bond will feed directly into our client accounts. Now, one disclaimer here. In our SimpleVisor portfolios that we run, we did the ETF swap. We went from TLT to EDV, which is the Vanguard long duration bond. The reason that we did not do an individual bond in SimpleVisor is because we don't have a way to track the daily prices of terms of a data feed in SimpleVisor. So for performance reporting purposes inside of SimpleVisor, we had to use the ETF. So again, you won't see it in SimpleVisor, but in our client accounts and our managed accounts that we run, we did this swap from TLT to an individual 20-year treasury bond.
Mike, Lance, can I add one more benefit?
Absolutely, and I was just going to let you have the last word as we get ready to wrap up the segment anyway. Go ahead.
Perfect. So we also added about 25 basis points, 0.25% of yield versus TLT. And that's because there's somewhat of a unique opportunity. When you look at the yields of the 20-year bond versus the 10-year bond and the 30-year bond, you pick up 30 basis points over the 10-year and 20 over the 30-year. So not only do we pick up extra yield because there's kind of a sweet spot on the curve right now at the 20-year point, but we also eliminate the expenses. So we're picking up, I think it's more than 25 basis points in additional yield on top. And, like I said, we got over 4.5%. Yeah, I love it. I love it.
Exactly. All right. Come back from the break and pick up with Michael Leibowitz, and we'll close out the segment, the show this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Just getting ready to wrap things up with Michael Leibowitz. As always, be sure and get by the website. His latest article is out on the website yesterday. And in fact, we're going to talk a little bit about this because, again, we write a lot of our, always kind of fascinating, always hear from people like, well, what's your thoughts on this? Is like, well, we just wrote an article on this like a week ago. So if you go by the website, realinvestmentadvice.com, it's just a ton of information. Subscribe to our weekly newsletter, talking about the link between oil prices and the economy this weekend. So if you want to know about all, it's always full of, the newsletter is full of charts and graphs and stock market analysis and stock screens and just a whole variety of stuff to help you manage your own portfolio better. Produce 3 blogs a week on the website, absolutely free. Our daily market commentary, there's just so much information there for you to consume. And it's all free. So why not take advantage of it? realinvestmentadvice.com. But we were talking about in the last segment about the bond swap that we made. And, I made this comment about risk-free debt. And when you talk about government bonds, right, it is the de facto presumption that it is a risk-free investment. In fact, it's the only risk-free investment in the world, because it's basically a guaranteed repayment by the government. So the government can print money to repay the debt. So the markets consider the treasury bonds of all makes, right? If it's issued by the U.S. Treasury, it's considered a risk-free investment. So when we talk about the risk-free rate of return, what's the risk-free rate of return? Well, that's based on the U.S. Treasury, because there's assumption that there's no risk. It will always be repaid. Corporate bonds, you have the threat of default, non-payment. Municipal bonds, threat of default, the payment. Stocks, no guarantee that stock prices only go up. So, even though people think that. But the question really comes down, is it really a risk-free government issue? And Mike wrote an article on this, and I thought it was quite interesting. And this is on our website now, on our blog page. So simply just go to realinvestmentadvice.com, click on the Insights tab. You'll find our blog there. But Mike, you wrote this article asking the question: Is it really risk-free? What was your takeaway?
So technically, yes, it's risk-free. The government, the Fed, will print money to ensure that every dime that you get in interest and in principal will go to you. So, when people say is it risk-free or not risk-free? The answer is yes, it's risk-free. But there's another risk that so few people talk about, and it's the real risk. It's the risk to our prosperity. That in order to sustain such high debt levels, the Fed, over periods of time, not necessarily every moment, but over periods of time, must ensure, and I use the word must, not try to, but must ensure that interest rates are very low. That's the only, it is a Ponzi scheme. The U.S. government is a Ponzi scheme. It borrows more every year than it takes in. That's not sustainable unless you keep interest rates extremely low. And it's amazing that over the last few years, the interest expense for the U.S. government has risen more than it did in the 50 years prior. That's a crazy statistic when you think about it. And what it tells you is that what's going on today with high interest rates is not sustainable. There's still a whole lot of debt that is on the government's books that's below market rate. So every day that goes on, there's a new bond that's maturing. And, some of those bonds may be 5 or 6%, and the government may actually benefit when it refinances. But a lot of them are well below current levels. And every time they have to mature, every time a bond matures, they issue a new bond. And that bond, in most cases, will have a much higher interest rate. So the government's interest expense will only rise. So what the government has to do to afford that, and it's not just for the government, it's for the economy. We are a very highly leveraged economy, very dependent on low interest rates. Higher interest rates are a big tax on economic growth. So the Fed is raising rates right now to try to control the economy, to slow the economy. But, like we said earlier, our economy is a 1.5%, 2% at best economy, and at times well below that. So the Fed, in time, will have to lower rates to A, help the government control their spending habits, and B, help the economy. You can't have interest rates at 4 or 5% with a true economy running at 1 to 2%. It doesn't work, especially, I can't stress this enough, with the amount of leverage in the system and the amount of economic, the way we stress industries that rely on debt, autos, cars, are a much bigger portion of our spending than they used to be. So, again, what we're seeing today, what we've seen for the last few years, is an anomaly. The fiscal spending is an anomaly. What the Fed did was beyond belief, and we thought we've seen everything prior to that. And what the Fed is doing now is not sustainable. So we're still kind of living in the pandemic anomaly, even though the pandemic may be gone, may not be. Now people are wearing masks again, it seems. But the after effects and the effects of that stimulus and that pandemic and the behavioral changes we've talked about before are big, and it's creating some massive distortions. But, going back to our bond discussion, you can't let those distortions ruin or change your outlook for the next 5-10 years, because they are distortions. They're not sustainable distortions. So the risk of government bonds is the cost of paying for those bonds, and that's lower rates, that's lower prosperity for the people. It's a greater wealth divide between the rich and poor. All the things that we saw prior to 2020 will come back in spades.
Well, and I think this is also kind of, really, this is something I'm touching. I'm actually picking up on your article to touch on a second part next week, is about this whole myth of bond vigilantes, right? We've heard about this, and actually bond vigilantes were kind of termed back in 2011. Was when one of the first kind of articles on the bond vigilantes returning, and this has been an ongoing kind of worry in the markets ever since. And every year we go through, every time rates tick up a little bit, it's like, the bond vigilantes are coming back. And in theory, what they're talking about is that at some point, the bond buyers simply will just kind of revolt and not buy bonds, right? And this is going to cause interest rates to spike off to the moon. And in a free market environment, That's very true. At some point, think about the corporate bond market or the municipal bond market. At some point, there may be a point where companies are so virtually bankrupt that nobody wants to loan them money, right? So there's the bond vigilantes basically won't loan money, and there's no traction for companies to acquire debt. And this is the thesis that's going to happen, and has been the thesis now for over a decade. These bond vigilantes are just going to revolt and no longer buy U.S. debt, and this is going to cause a massive problem for the economy. However, this belies the one underlying truth that ultimately there is always going to be a buyer for debt, and that'll be the government. The Federal Reserve, U.S. Treasury will buy the debt. And if you don't think that can be the case, we've talked about specifically the events that will lead to this, and it's called yield curve control. Japan now owns a very large chunk of their own government bond market in order to suppress yields. So this whole idea, Mike, that bond vigilantes are going to show up and create this massive destruction in the overall bond market is really mostly a myth, because, again, at some point, if interest rates become an impediment to the economy or create a deep recession or threaten, heaven forbid, threaten the financial, markets itself, the major banks, Wall Street, the Federal Reserve is going to step in and start buying bonds hand over fist. And we've already seen them do this through 4 rounds now of quantitative easing.
Yeah, I think higher interest rates are just as dangerous to this company as countries like China or Russia or North Korea. It will destroy, high interest rates for a long period of time will destroy the economy. Mm-hmm. And, there's enough political problems as is, enough wealth divide, enough problems that the government cannot allow, just like it cannot allow Russia to do what it wants to do or China to do what it wants to do. It will not allow interest rates to stay higher once they meet their inflation goal. And look, that's why the Fed is so intent on getting inflation down. Jerome Powell made no bones about it. He said inflation will get to 2% because he knows he has to get inflation down to get inflation down to get interest rates down. Mm-hmm. So he's under pressure to meet his goals of 2%. But I'm sure the White House and Congress are hounding him every day. You've got to get this inflation down.
Mm-hmm. Well, and again, inflation's one thing, right? Again, we talk about inflation and it's like, oh, inflation's, up and, gas prices, food prices, all this stuff. But ultimately, and you hit you kind of nailed it, which is simply is that, yes, getting inflation down is important, but that's also mean getting interest rates down. Getting inflation down without bringing interest rates down doesn't really solve your problem. Yes, I have lower prices, but I still can't finance anything because rates are too high. You have to get them both down at the same time. And again, since they are a function of each other, it's going to happen naturally.
Right.
So last word here before we wrap up the show for this morning. You got it.
We keep stressing bonds, but I can't tell you how much I think there's a great opportunity if you're willing to look beyond the daily gyrations in bond prices and bond yields for the next weeks or months or whatever it may be.
Yeah, investing is a long-term horizon. Risk-free government debt, fact or fiction. On the website now, it's Michael's latest article. In the meantime, also while you're there, make sure and subscribe to our daily market commentary and our newsletter this weekend. We'll talk about the link to oil prices and the economy. So much more to help you out, manage your money better. It's all at the website, realinvestmentadvice.com. Have a great day. Tomorrow, Danny Ratliff, Richard Rosso here for Financial Fitness Friday, and have a great weekend.